Hey, Kyle here. I'm a loan advisor with WinTheHouseYouLove.com. Today we're talking about how do you sell a home with a mortgage. So if you're looking to sell your house but it has a mortgage on it currently, how are you going to handle that when you're moving into another property? Maybe you're going somewhere else and renting, most likely not, but you're probably going to go and purchase something else. So first of all, you need to get that mortgage paid off. The mortgage is not going to transfer to a new property. You're going to pay off this mortgage, and then you're going to get a new mortgage on that new property. And the reason why is because the way mortgages work is they are secured by one particular home. Okay, that home is used as the collateral to support the mortgage note. Okay, so you can't go and transfer that to another property. You have to get a new mortgage. So let's talk about how to do that. It's really not difficult. This happens most of the time for most sellers. When they sell, most of the time people are paying off a mortgage. So let's talk about 6 things that we need to consider. First, let's talk about what's the overall structure look like. So I have this chart here, and we can see overall we see the big green box. This is our sale price. So let's say that you are selling your home, okay? And let's say that you're selling it for $200,000. All right. So we're selling our home for $200,000, but we have a loan on it currently. And let's say we assume our loan is about $150,000. That's how much we have remaining to pay down on this mortgage. Now, the current balance that we have is different than the payoff amount. So we need to first find the payoff amount. The payoff amount is going to be slightly higher than your current outstanding balance. And the reason why is because that mortgage company that you have right now, they're going to calculate a certain amount of interest. So they're going to say, maybe if our loan balance is $150,000, our payoff might be closer to $151,000 with interest for a certain period of days. So they're going to say your payoff is good for 30 days, 60 days. So what you need to do is contact your mortgage company, ask them for a payoff so you can get a really good idea of how much your loan balance is here. Now, this loan balance is going to include your mortgage plus any second mortgages you have. So home equity lines of credit, any other liens attached to the property as a home loan that's riding as a second lien on the property. That's all included in that loan balance. Okay, so we have our payoff taken care of. Now we need to focus on the equity of the property. All right, so equity is how much basically cash you have built up in the value of your property. Now, it's not realized yet, meaning that you won't get that cash until you sell the property. It's wrapped up in the asset. So your equity is this portion right here, okay? And the equity is going to be the total purchase price or the sale price minus your loan balance. And that's how much equity you have. So if we have a sale price of 200 and a loan balance of 151, we have about $50,000 worth of equity minus the extra $1,000 for interest is closer to about $49,000 worth of equity in this little range right here. Okay? All right, so this equity, what are we going to do with it? Most of the time, we're going to take this equity and use it as a down payment on a new home. So then if you sold your home in this scenario, you now have 50 grand to go put as a down payment on another house. But the problem is we're going to run into costs. So when you're selling a home, there's going to be costs with selling. One of the biggest costs you'll run into is commission for a realtor. All right, so as the seller, it's very traditional for you to pay 3% for your realtor and 3% for the buyer's realtor. All right, now that's going to cut into the free cash you're going to get at the end. So let's say that right here, this is 6% just in costs right up front. So let me pull up my calculator. Can't do all this in my head. Okay, so if our home was $200,000 times 6%, we're going to be looking at 12 grand right off the top in costs. So if we took our equity, which is 50 grand minus 12,000, now we have 38,000 remaining minus that 1,000 for the payoff. So we have now $37,000 remaining in equity that we have. Okay, so you're going to run into realtor costs. You also might run into some other costs. Maybe you're giving the buyer a credit towards their closing costs. Maybe you have different taxes to pay. You might have transfer taxes depending on the state that you're in. And what you can do is you can contact a realtor or a title company and see if they can give you an estimate of what your net sheet would look like. And a net sheet is going to tell you all of these numbers estimated except for your payoff. You'll have to get that on your own. But once you get a net sheet and you get a correct payoff, you should have a really good idea of how much you're going to net from that property. Okay. So this is all assuming that your home is worth more than your current balance. Let's talk about what happens if that's inverted. So if you're trying to sell your home, let's say again, it's a $200,000 house, but you still owe, let's say you owe $200,000 on it, or maybe you owe $195,000 on it. Well, with all of these costs and everything else involved, this is what's being called being underwater. So you owe more on the home than you can sell it for. All right, so there's pretty much 3 different solutions if you're underwater on your mortgage. Number one is to bring that extra money to the table. Okay, so if you were short, let's say $20,000, you'd have to bring $20,000 to the table to sell your home. Okay, it's not favorable, but that is an option. Number 2 is the least favorable option. This is to do a short sale. A short sale is where you contact your lender and let them know that you have to sell this property because of something that's going on in your life, and you need to sell it for less than you owe. Okay, this is pretty rough on your credit and can prevent you from purchasing a home in the near future. So something to be very careful of. You can't really do a short sale and then immediately purchase something else after. You'll probably have to rent for a while until you build up your credit and some of that short sale seasoning falls off, which is usually around a 2-year waiting period. The third option is to simply just wait. So if you need to get out of your home but you can't sell it, an option that you might have is renting it, maybe to friends or family if you can, or somebody else. That might be a good way to alleviate that burden if you really need to move. But if you need to access that equity and you don't have any equity in the property, you're just gonna have to wait a little bit until the market changes and it either goes up so you have equity or you pay down your loan balance. Okay, so the easiest way for you to sell and then buy is going to be to sell first. What happens most of the time when people are selling and buying at the same time is they can't afford 2 mortgage payments. So they can't buy first and then sell. And also they need money for this down payment when they purchase. So what normally happens is you start by listing your home. Okay, and then you set up a closing date. All right, so we're going to set up a closing date for your home to sell. All right, then what you're going to do is write an offer on a purchase. Okay, then you would close the sale, and very shortly after, close on the purchase. All right, this is the easiest way to do it because you can transfer the equity over into the new purchase and you don't have to make 2 payments at the same time. And you don't have to worry as much about the hassle of coordinating moving, because sometimes you can even set up this time period to be 1 day or 1 week. That way you don't have to worry about, will we have a house to live in? Those closings coordinate back to back. All right. And then finally, what happens to the escrow? So when you have a mortgage with escrows, you're going to have a little account off to the side that's going to have funds set aside that you had in there for insurance and taxes. All right. So when you sell your property, that mortgage company is going to give you a check back for that escrow account. So you'll get this money and it comes back to you as soon as you close. It might take a couple weeks for that check to come in, but then you can take that escrow money and then put it on the new payment for the house if you would like to. Okay, so I hope this helps you, gives you a good idea of what it's like to sell a home with a mortgage. It really is not all that complicated. The best thing that you can do right now if you're considering selling your house with a mortgage is first figure out how much are you going to net. Not just a general idea of how much do you have left versus how much you can sell it for, because that's not the true number of what you're netting. All right. So figure out an idea of what you could sell it for, talk with a realtor if you need to, figure out your payoff. So contact your mortgage company, find what your payoff number is, and then talk with a realtor or a title company to get a net sheet to put all those costs together. All right. Thanks so much for watching. If you enjoyed this video, please like it or subscribe. Also, I answer all of the comments, so leave me a comment if you have any questions. I would love to answer it. Thanks so much for watching.